this set of papers looks at various individuals' evaluations of credit risk. And I think I should just point out in the beginning that there's no one definition of credit risk. For example, even the credit rating agencies disagree. Standard & Poor's bases their ratings on the probability of default. Moody's and Fitch base their rating on expected default losses, which includes the probability of default and loss given default. And even investors have a different way of evaluating credit risk by perhaps a credit spread, which is a market-driven measure of credit risk. So their credit spread over a safe interest rate would be another measure. And that could include also systematic default risk premium. But even if individuals agree on the same definition of credit risk, their evaluations may differ. And one way that it may differ is due to moral hazard. The first paper really focuses on this reason. Banks may inflate their rating if it benefits them from a regulatory perspective. At least that's the potential bias that's being examined. And then the second paper on small business administration employees is really saying, well, maybe credit evaluations differ due to psychological biases, this irrational risk salience. And then the third paper might say that, well, credit ratings such as credit scores are going to differ because of differences in information. In the earlier period before February 1st, during the pandemic, people who went into hardship programs were reported. Afterwards, they were not. So there's a difference of information. So let me begin going in a little more detail on the first paper that Stephen presented. This paper looks at ratings set by banks that were lead arrangers or agents in large syndicated loans and compares them to examiner ratings for those same loans. And one thing that kind of struck me is that the highest rating pass is about 87% of the observations. Now, if a professor gave A's to 87% of students in their class, you can probably bet that there is a wide variation in the aptitude of those students that received A's. And so here I think, given that 87% of the loans get the highest pass rating, there's probably a good amount of variation within that rating. Now, the paper does two primary exercises. One is that it models loan rating changes over time to see whether there's an upward bias in ratings by banks. And then it also does a second exercise where it compares ratings set by examiners relative to the ratings set by the bank just prior to when that loan was examined by a regulator, a bank regulator. So the first part of the paper uses a rating transition model, which is actually a model that's commonly used to model credit ratings, credit rating changes by, say, Moody's or Standard & Poor's. And when you test whether there's this rating inflation using such a model, it's really a joint test of the model as well as whether there's actual bias. And so some prior work has found, well, maybe there's some weaknesses in these models, and I'd maybe like to see the paper discuss this a little more. Are rating change probabilities likely to be constant over time, such as over the business cycle, which I think is one of the assumptions of the model. That may or may not affect the results, but it might be something that the authors would consider. Now, the paper also finds evidence that examiner ratings tend to be worse than those previously assigned by banks, and that's consistent with banks inflating their ratings. But there might be another possibility that I thought about, in that examiners know the bank's rating before they assign their rating. And might examiners have a bias themselves against giving a better rating than what the bank had just assigned? In other words, you would think, I think, and Joe Face mentioned this earlier today, that supervisors are not supposed to be friendly. And you might think that to show that you're going to be a tough regulator, you're not going to give a better rating than what a bank had previously set. And the bank may know something that you don't know. So that would create maybe a bias against examiners setting higher ratings. Also, since 87% of the ratings are the highest pass rating, it seems that like most rational disagreements between banks and examiners can only result in a worse examiner rating, at least for those that are clustered at that highest level. So these issues may or may not change the interpretation of the paper result, but one result that I do find very credible is that the paper finds that banks learn from an examiner's rating, and that if a examiner sets a lower rating on a particular loan, banks will adjust their ratings for similar loans of firms in the same industry. Okay, so let me go to the second paper that Siddharth presented. This paper uses 1998 to 2019 data on small business employees, Small Business Administration employees and loans. And it shows that current defaults on loans guaranteed from offices where a small business administration employee previously worked reduce the amount of guarantees that will be given in the new office of the Small Business Administration. And as a result, the small business employee in the new office seems to act more conservatively. They make loans that default less. They guarantee loans that default less. But that has adverse consequences in some sense because it reduces the number of small firms in the offices, the new office's location, reduces job creation. And so there's a downside to that. Now, the effect is greater when the employee's new office is a small one, and decisions are decentralized. But it's mitigated if employee compensation is performance-based. So I think this paper's results are really intriguing, and the estimates are really quite large for this effect on risk salience. Let me give sort of a perspective of what's going on here. Now, prior research has found that employees' prior experiences affect their decisions. For example, someone living through the Great Depression tends to not want to invest a whole lot in stocks. They tend to have more conservative investment choices. The current paper is a little bit different because it finds that current events in an employee's old office, which may be thousands of miles away, affect their decision at their new office. So defaults that are happening now in the old office affect the employee's decisions in a new office. Now, might another explanation be that employees tend to specialize in guaranteeing loans for particular industries, and they continue to have responsibility for the prior work in their old office. Well, that means that they may need to explain defaults in their old office. For example, if they guaranteed a defaulted loan, will they have to explain that? Will they have to assist in workouts? If so, perhaps that could reduce the productivity of guaranteeing loans in the new office. And so this could be another possible channel that the authors might consider. That could be one reason why they're guaranteeing performance declines, and maybe they just picked the best loans to guarantee. If compensation is based on performance in terms of the amount of loans that they guarantee, then that could be a reason why performance-based compensation reduces this reduction, that reduces this effect of the paper. So let me get to the last paper. Alex mentioned that what's going on in this paper is that there was a policy change that happened in February of 2020, just around the beginning of the panic, that borrowers who were entering hardship programs prior to February 1st were reported to credit bureaus. Borrowers who entered hardship programs after February 1st were not reported. So the former are this control group, the latter are the treated group. And the treated borrowers, because they were not reported, had higher FICO scores compared to the control group. Why? Because the control group went into this hardship program that was reported. Of course, that's an adverse event. As a result, the treated borrowers had relatively lower post-hardship default rates compared to the control group, and the treated borrowers had relatively higher loan repayment rates. Okay? Now, among the paper's conclusions are that if you exogenously increase credit scores, even if one doesn't deserve that higher credit score, that's going to raise borrower performance and reduce default. And on the flip side, a credit bureau reporting that errors by having too high a credit score can be costly because those borrowers are penalized. Now, I think the paper's test design is very clever. One interpretation of the CARES Act that mandated that these borrowers going into hardship not be reported is that, in some sense, it forced a credit bureau error that favored the treated borrowers. Now, with the loss of reporting, treated borrowers were grouped or pooled with truly better quality borrowers that did not have hardship. And as a result, you might think that these treated borrowers who really did enter hardship are being grouped with these better borrowers, that they were being, in some sense, cross-subsidized by the better borrowers in the same FICO score group. Now, there's a subtle issue here, because if lenders recognize this, then they may, in fact, raise the cost of credit or reduce the amount of credit to borrowers in that same group, that higher FICO score, if they, in fact, do know that the CARES Act led to this non-reporting. And that could have potentially poor welfare effects because it in fact penalizes the better quality borrowers for the same FICO score. And if enough borrowers are misreported, that could really have detrimental consequences. Lenders may just completely decide not to lend, what would be a so-called lemons market. Now, several of the paper's tests are set in event time. What that means is that we compare borrowers before and after hardship. So the control group might have gone into hardship in December of 2019. The control group went into hardship after February 1st, 2020. There could be some potential difficulties with that in that in April of 2020, the CARES Act had stimulus checks being distributed to just about everyone. And those checks were received earlier by the treated group than they were the control group, because the treated group went into hardship after February 1st. The control group might have been having to make do without stimulus checks for a longer period of time. And I just wonder whether that may have led to differences in the results, the fact that the treated group received this government aid earlier than the control group. And so, this is sort of consistent with other research that has found that counterintuitively, there were actually less defaults after the pandemic started than there were prior, less personal bankruptcies after the pandemic started than prior. And potentially maybe the paper could be picking up this effect. So let me just finish up and to say that one way of alleviating this might be to reduce the sample period. Maybe just compare the control group as those going into hardship in January of 2020 and those going into hardship just in February 2020 to try to mitigate this potential differences in the timing of government aid. So let me conclude that I think these papers highlight important reasons why banks, bank regulators, and government loan guarantors' credit evaluations may differ, and they point out that there's potentially large economic consequences to these credit evaluations that need to be considered.